Welcome to the Deep Dive, where we cut through the noise and get straight to the crucial insights from earnings calls. Today, we're taking a deep look into Marathon Petroleum's second quarter 2025 results and what those numbers signal for the broader energy landscape.
Yeah, we've poured over the financials, really dissected management's commentary, and looked at the market's initial reaction. Our mission today is to give you a real shortcut, being well informed on this quarter's key developments, making sense of what really matters for investors and the industry as a whole.
Okay. And Marathon Petroleum certainly delivered a financial quarter that caught a lot of attention. Right out of the gate, GAAP and adjusted earnings per share, or EPS, came in at a robust $3.96.
Right, yeah.
That's significantly ahead of the $3.29 consensus estimate that Wall Street was expecting.
Big beat there.
Revenue also beat expectations, hitting $34.10 billion against a $33.04 billion consensus. And on top of that, adjusted EBITDA was pretty healthy at $3.29 billion. Cash flow from operations, excluding working capital, stood strong at $2.6 billion. Those are some impressive top-line numbers, wouldn't you say?
They absolutely are. And what truly stands out for me are their refining metrics. We're talking about a refining and marketing margin of $17.58 per barrel. A remarkable 97% crude run utilization.
Yeah.
I mean, they're running those refineries incredibly close to full capacity.
97% is huge.
It is. And an impressive 105% margin capture.
Okay, that 105% figure really catches the eye. What does that signal?
Right. It indicates their ability to extract value from every barrel of crude beyond the sort of theoretical maximum, often signaling superior optimization, maybe product mix, strategic trading.
Yeah.
Things like that.
Interesting.
But despite these stellar operational and financial beats, the initial market response was, well, surprisingly muted.
Yeah.
Yeah, that signals some interesting underlying considerations for investors, which, we should probably dive into.
Okay, let's unpack that then. When we look at their refining execution, Marathon CEO Maryann Mannen, she consistently highlighted refining execution and a constructive long-term outlook. She really emphasized that 97% utilization and that 105% margin capture as peer-leading and, crucially, sustainable. So this wasn't just a one-off stroke of luck, was it? Sounds like structural improvements.
That's precisely it. This strong performance was clearly underpinned by strategic commercial efforts, leveraging their integrated value chains across, the West Coast, Gulf Coast, and Mid-Continent.
Right.
Management specifically pointed to the robust global demand for diesel and jet fuel, coupled with tight inventory levels as key drivers. They've significantly leaned into those higher value product channels, which allows them to optimize their output even when broader market crack spreads. That's the difference between crude price and product prices might not be at their absolute peak.
So it's a testament to their operational discipline.
Exactly.
So we've got a strong picture on the refining side. But Marathon isn't just a refiner, is it? Let's talk about their midstream segment, MPLX. That seems to offer a different kind of stability.
It absolutely does. And that consistency from MPLX is actually a unique differentiator for Marathon in the refining space. This quarter, the midstream segment continued its consistent growth, delivered a 5% year-over-year segment adjusted EBITDA increase in the first half of 2025.
5%.
And importantly, Marathon received $619 million in distributions from MPLX this quarter. That's a substantial 12.5% increase compared to last year.
12.5% increase. Wow.
Yeah. MPLX is well positioned for mid-single-digit adjusted EBITDA growth, providing a significant, durable cash flow stream that truly differentiates Marathon from many of its peers. This fee-based revenue stream provides a crucial layer of stability, helps smooth out the inherent volatility of the refining cycle.
Right, that makes sense. The quarter also saw some really interesting strategic portfolio optimization moves. Marathon divested its $425 million stake in an ethanol joint venture. What was the thinking there?
Yeah, management stated this exit came at a very compelling multiple, so they got a good price for it, primarily due to diverging strategic goals with their partner.
Ah!
The key takeaway for us, though, is that it has no commercial impact on their position as the largest ethanol blender.
So strategically sound.
Seems like it.
Yeah.
A smart divestiture because it streamlined their portfolio, shedding an asset that may be no longer aligned with their core direction, and freed up capital.
And speaking of capital allocation, they made an acquisition too, right? Through MPLX.
They did. MPLX announced the $2.375 billion purchase of Northwind Midstream. This is a Permian sour gas gathering and treating platform.
Sour gas, so processing gas with impurities.
Exactly. Critical infrastructure for making that natural gas ready for market. This acquisition is expected to be immediately accretive to MPLX's distributable cash flow and significantly expands their Permian footprint, extending their growth duration.
So a long-term strategic play?
Yeah, capturing more stable, fee-based cash flow, enhancing that midstream optionality we talked about.
Okay. Now, a core tenet of Marathon's strategy has always been shareholder returns. This quarter, they returned a significant $1.0 billion to shareholders, including $692 million in buybacks.
Big number.
That's a clear commitment, but does it fully address the underlying investor concern that might have led to that muted market reaction we saw initially?
That's the million-dollar question, isn't it? Management reiterated their commitment to return 100% of free cash flow, which implies another roughly $4 billion in buybacks over the next 12 months if current margins hold.
$4 billion more.
Potentially. This demonstrates strong financial discipline. They also showcased balance sheet strength, repaying $1.25 billion in senior notes at Marathon Petroleum and $1.2 billion at MPLX.
Deleveraging too.
Right. The company maintains an investment-grade credit profile. And MPLX's growing $2.5 billion annual distribution effectively covers Marathon's dividends and standalone capital spending. So while they're showing financial health and commitment to returns, the market seems to be asking if this level of profitability can truly be sustained. Moving Marathon from, a cycle hitter, heavily dependent on the refining cycle, to a structural cash machine.
A structural cash machine, I like that term, generating consistent returns across all market conditions.
That's the goal, I think.
And let's not forget the renewable diesel segment. Still relatively small, but it showed some progress, improved margins.
Yeah, benefiting from those incremental 45Z production tax credits.
Okay, remind us, what are the 45Z credits?
They're basically a federal incentive designed to encourage the production of clean transportation fuels. So it effectively boosts the profitability of renewable diesel.
Got it.
This segment ran at 76% utilization, even with a planned turnaround at their Dickinson facility. Now, it still registered a modest negative $19 million EBITDA drag this quarter.
Still a drag, okay.
But the company is sharply focused on optimization, leveraging their existing logistics and pre-treatment capabilities. The hopeful sign here is the potential for significant regulatory tailwinds to help flip this segment positive, maybe by 2026.
So not a major driver today, but strategic for the future, adapting to the energy transition.
Exactly. Especially as the world shifts towards lower carbon fuels, it's about positioning.
Okay, shifting gears now to guidance themes and macro trends. What can we expect for Q3? Marathon projects crude throughput volumes of 2.7 million barrels per day, translating to 92% utilization.
Still very high utilization, yeah.
And those turnaround expenses are projected at approximately $400 million, mostly mid-continent and West Coast.
That's right, with full-year turnaround expenses expected around $1.4 billion.
$1.4 billion for the year.
But interestingly, management indicated this full-year spend might actually be near its peak, suggesting a potential decline in future years as they work through a backlog from the COVID period.
So that could be a positive tailwind down the line, less spending needed.
Could be. Operating costs are projected at $5.70 per barrel, which is a key metric for their efficiency, showing good cost control.
Okay. On the operational front, we heard about the recent Galveston Bay RHU fire. That's a refinery hydrocracking unit. They said minimal impact on Q2, the 200 train is back, 300 train soon. How's this affecting their outlook?
Yeah, it seems they've managed it quite well. The impact's been incorporated into Q3 guidance. Only a minor effect expected on capture trends.
Good news there.
Looking broader, Marathon continues to prioritize investments in refinery upgrades, like at Robinson and Galveston Bay itself. These upgrades are specifically aimed at increasing distillate yields.
Meaning more diesel, more jet fuel, the high-value stuff.
Exactly. And producing even higher value products overall, with targeted returns around 20%.
20% returns. Pretty attractive.
It is. This isn't just about pushing more crude through. It's about extracting more value from every single drop.
Right.
Now, management anticipates crude differentials will widen in the back half of 2025. For those of us less immersed in crude pricing nuances, what does that mean for Marathon? And why is it happening?
Yeah, this is generally great news for sophisticated refiners like Marathon. Crude differentials refer to the price difference between different types of crude oil, light versus heavy, or sweet versus sour, or regional differences.
Okay.
A widening differential means the discount for heavier, more complex crudes, which Marathon's refineries are really good at processing, increases.
So they can buy their feedstock cheaper relative to lighter crudes.
Precisely. This outlook is driven by anticipated increased OPEC plus production, particularly that 547,000 barrels per day accelerated for September, and a bullish Canadian production outlook now that maintenance is behind producers up there.
And Marathon is positioned to benefit.
Uniquely positioned, actually. They can consume more heavy Canadian crude than any other refiner in the U.S. So this gives them a significant competitive advantage when those differentials widen, improves their profitability. Got it. Okay, let's talk California. 2 pending refinery closures there. The competitive landscape is definitely shifting. Marathon highlighted their $700 million investment in their LA asset. Expected to complete this year, improving efficiency, reliability, cutting no-knox.
And targeting a 20% return, yeah, they foresee significant opportunities there, including enhanced access to advantaged local California crude barrels.
Interesting.
Their integrated system, including facilities up in the Pacific Northwest, Anacortes and Kenai, plus El Paso, provides critical flexibility to serve the entire region, including that crucial Phoenix market.
So they can move product around efficiently.
Exactly. And what's particularly fascinating here, management noted a palpable shift in the state's regulatory approach.
Oh, how so? California is usually seen as tough.
Historically, yes. But agencies are now becoming more receptive to discussions on ensuring ample fuel supply, even potentially expediting permitting processes.
That is a notable change. Could be a long-term positive for their West Coast operations.
It really could be.
Okay, diesel cracks. They've shown significant strength recently. What's driving that, and how does Marathon see it playing out?
Yeah, the strength is primarily attributed to historically low U.S. inventories of diesel and robust demand from both over-the-road customers, think trucking, logistics, and strong jet fuel demand.
Which indirectly pulls from the diesel supply.
Right. Management remains very constructive on diesel cracks sustaining healthy premiums through the rest of the year, especially with winter heating demand coming up and, hurricane season potentially adding further tailwinds through supply disruptions.
So a positive outlook there for a key product.
Seems so.
And finally, on the macro view, management maintains a very constructive long-term view on the refining sector as a whole. Why so optimistic, given all the energy transition talk we hear?
Well, they project global demand growth of 1 to 1.2 million barrels per day through the end of the decade. And they expect that growth to outpace the net impact of new capacity additions like Dangote in Nigeria or Dasbus in Kuwait, plus any rationalizations of older refineries.
So demand growth outstripping net supply additions.
That's the projection. Essentially, they believe demand will grow faster than new supply comes online or old supply is retired. And the U.S. refining industry, including Marathon, is viewed as structurally advantaged. Scale, complexity, access to advantaged crudes.
Which raises that question again. If the sector is viewed so strongly long-term, what does that imply for Marathon's stock valuation if they can prove they're a structural cash machine?
Exactly. That's the potential re-rating story investors are looking for. Shifting perception from cycle hitter to something more durable.
And quickly on the cash tax front, Marathon expects a benefit.
Yes, a nice one. This is due to the permanent return to full expensing on capital investments, retroactive to January this year.
Full expensing, meaning they can deduct investment costs faster?
Right. For a capital-intensive business like refining, where they invest billions in upgrades and maintenance, this is a significant positive for their free cash flow. Improves their ability to generate cash for those shareholder returns we talked about.
Okay, so wrapping up our investor context for Marathon. Year-to-date total return is about 19%, outpacing the energy ETF XLE by around 7 percentage points. So good performance for shareholders this year.
Definitely. And management's overall tone was certainly bullish, particularly emphasizing that disciplined refining execution plus midstream optionality can smooth the margin cycle. Sell-side analysts like TPH & Co. highlighted their best-in-class utilization and capture rates. TD Cowen even bumped their price target, citing buybacks and midstream synergy.
But despite the earnings beat, that buy-side reaction was indeed muted. Stock drifted slightly lower.
Yeah, signaling those underlying concerns about the sustainability of these strong margins. Investors will be closely watching a few key things now. Q3, throughput discipline, definitely. The Northwind acquisition close, and any synergy updates in the second half of 2025.
Clarity on Galveston Bay repairs.
Right. And of course, crack spread volatility tied to hurricane season, geopolitics, all that macro stuff. The critical question for many is, can management sustain greater than 100% margin capture into 2026?
That seems to be the key.
If they can consistently do that, it could truly shift the narrative. from cycle hitter to structural cash machine, potentially paving the way for a higher capital return rate and, importantly, a significant re-rating of their stock multiple.
That's the real long-term prize they're aiming for, it sounds like.
I think so.
Okay. Now for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea, just like a hedge fund analyst might.
All right. Given Marathon's demonstrated ability to consistently deliver that best-in-class operational performance, their strategic investments in higher value distillate yields, and the robust growth from their integrated midstream assets like MPLX, here's a thought for you to chew on. Consider a long position in Marathon Petroleum, ticker MPC, paired with a short position in a less diversified pure-play refiner.
Okay, so a pairs trade. Long MPC, short a competitor.
Exactly. Especially shorting one without significant midstream exposure or a strong competitive position in that tightening West Coast market.
And the thesis.
The thesis is that Marathon's unique combination refining excellence, integrated value chains allowing optimization, and that stable, fee-based midstream cash flow from MPLX will enable it to consistently outperform peers through all parts of the refining cycle, allowing it to truly morph from being just a cycle hitter to becoming that structural cash machine, and, in turn, command a higher valuation multiple in the long term, regardless of short-term crack spread volatility.
So it's a bet on their structural advantages and superior execution winning out over time.
That's the idea, a bet on quality and diversification within the energy space.
Interesting. Well, that wraps up our deep dive into Marathon Petroleum's Q2 2025 earnings call. We've seen strong operational performance, smart strategic portfolio moves, and a clear commitment to shareholder returns, all playing out against a pretty dynamic industry backdrop.
Yeah, while the market's immediate reaction was tempered, the underlying story of disciplined execution and strategic optionality is undeniably compelling. The crucial question remains, can they sustain this level of operational excellence and convert it into a higher, more consistent valuation? It'll be fascinating to see how these catalysts play out in the coming quarters.
Absolutely. And remember, this analysis is for informational purposes only. It is not financial advice.
We always encourage you to review the full details yourself and conduct your own thorough research before making any investment decisions.
If you have more questions or want to dive deeper into any of these topics, connect with us. Thanks for tuning in to The Deep Dive.